with tonight's class on contracts for differences, or CFDs. Now, they are a very fast-growing instrument. The trade numbers are going up the volume is going up daily. Now, they are becoming quickly the most interesting and exciting way to trade. Again, because they're regulated, they are safe to trade. But as opposed to futures, you can buy in units as opposed in contracts, so you're not having to commit to huge volumes. In futures trading, a contract is very specific, and it's through an exchange, and you have to buy like a lot of crude oil is 1,000 barrels of crude oil. A lot of gold is 100 ounces of gold. When you're trading CFDs, you buy units, and you can buy as many units as you want, and it's simply based on the price. There's a sell price and a buy price. Okay. So CFDs stand for contract for difference. This type of financial instrument allows you to benefit from the fluctuations in stocks, commodities, and indices and more without really purchasing them. You can profit from the difference between the opening price and the closing price of a certain position on a particular instrument. It's important for us to emphasize you don't own the asset you trade. You are receiving the rights to buy or sell at a specific price. Now, CMS Trader was one of the first online brokers to offer CFD trading, giving individual traders access to a large range of markets which were not accessible to them before. Now, a CFD is a leveraged derivative financial product. That's a lot of big words, isn't it? CFDs are derivatives because their value is derived from the value of another asset. For example, a share, a commodity, or a market index. When you trade CFDs, you take a position on the change in the value of the underlying asset over time. You are essentially betting on whether the value of the underlying asset is going to go rise or fall in the future compared to what it was when the contract was taken out or executed. So if an asset, say the euro is trading at 109.52, and you think the euro is going to go to 109.74, you can take your CFD. But if you were buying it in the Forex market, you'd have to take $100,000 worth of euros. That's a big investment, especially for people that only have $1,000 or $2,000 in their account. Where when you trade CFDs, you can take the units. You can get smaller investments. Now, all CFD companies or providers let you both buy long or short. Going long means you're buying a CFD in the expectation that the underlying asset will increase in value. Going short means selling a CFD with the expectation that the underlying asset will decrease in value. In both cases, when you close the contract, you hope to gain the difference between the closing value and the opening value. Not so complicated, is it? Now, you can trade share prices, foreign exchange, indices, commodities, and even treasuries. You can trade on the price movement of thousands of instruments in the global financial markets. So basically, you can trade anything you need to trade in the format of a CFD. Now, what are CFDs? So for example, you might want to buy a CFD to go long or to say it's the price above over company X's shares. Okay. If the price of company X shares rise and you close out your CFD, the seller of the CFD, the counterparty, will pay you the difference between the current price of the share and the price when you took out the contract. However, the price of the company's X shares fall, then you would have to pay the difference of the price to the seller of the contract. So if it goes up, you make the profit. If it goes down, if it goes the opposite direction in which you selected, because you can also sell short. So if Apple was trading hypothetically at 129 today, and you thought Apple was going to go to 140, and you bought Apple in a CFD, it still moves the same as the same underlying value of the share of stock. But if you really wanted to buy Apple shares and you had to buy them at 132 and you only had $1,000, how many shares could you actually buy? Well, maybe 8, 7. So if Apple went to 149, you made $17 a share, or 8 times $17, which isn't much by the time you pay commissions and fees. Whereas if Apple was at 132 and went to 149 and you were buying with a CFD, which is a leveraged product, you could most likely tie up 800 shares. So if Apple went up $12, you get 12 times 800, okay, because all CFDs are leveraged. So CFD margin, now, depending on the broker you're trading with and the particular class of the asset, there are different leverage amounts. Okay. But say, for instance, you bought a contract at 500p and it went up to 510p. The difference was 10p. Well, at 500p, you could only afford a couple. But if you were going along using margin, you would only have to put up 3% or 1,500 pounds to tie up $10,000 or 10,000 pounds worth of that CFD. So your net profit would be a lot higher, so you can obtain a lot more of that asset to trade with. Now finally, it cannot be stressed enough that trading in the financial markets carries a high level of risk and may not be suitable for everyone. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. Very important, risk appetite. Remember, you can sustain a loss of some or all of your initial investment, which means that you should not invest money that you cannot afford to lose. If you have any doubts, we recommend that you seek advice from an independent financial advisor. Now, don't be intimidated and confused by all the terminology that we seem to get ourselves involved with, like spot, CFDs, and futures. Basically, for all of us that are trading in the retail markets, they're all basically the same thing. What you really need to know first is what asset is underneath it. For example, if you might want to buy gold, you could buy spot gold, and that's the price at which you would pay for the physical gold itself. The price of spot gold is what you would pay a coin dealer that's selling you gold coins at the moment of taking physical delivery. So that is called the spot price. You could also buy a gold CFD or gold futures, but the price fluctuations are likely to be extremely similar. CFDs and futures use the value of the underlying asset and the spot price to determine the current price of the CFD or the gold future. Okay, they're not rigged. They are standard movements. So if gold is moving at spot price and gold moves from 1250 to 1251, most likely your CFD and your gold future will go just along with it, or it might be a couple of pips different because in futures and CFDs you deal with spreads. Okay. But there's nothing deceptive about it. Okay? There's nobody doing anything underhand because all three of these are regulated. Okay, so you have the regulators setting the rules and policies for any of these contracts. Now, the debate about CFDs versus Forex versus futures is really a waste of time and not worth worrying about. Spot and CFD are essentially the same thing at this level because most of us are not investing hundreds and hundreds of thousands of dollars where the difference of 1 point is going to make a difference, that much of a difference to our trading results. Difference in the price movements should only occur where a CFD is leveraged itself, but it is not very common. Futures are a little different as they can be less liquid and their prices influenced more by market forecasts. The important thing is to check how much each instrument costs you to trade. So there are two very important issues you should always be aware of, or three. One is always risk. Two is always tax scenarios. Different type of trades and different type of instruments are taxed differently in different governments, in different countries. So you have to be very careful because in a lot of countries, the profit on a CFD is non-taxable. It's not considered capital gains. Other countries, profit on futures are taxable. So you have to find that out. It's very, very important to you because that has a bigger result on your profit than the underlying difference between the spot and the CFD price. Lastly, you always need to be aware of your costs of a trade. Now, CFDs are quite simple. There are no underlying or no hidden costs. You buy in a spread and you sell at a spread. So in both cases, when you open in a CFD, you first open a contract, whether you're going long or short, and then you have to also buy the opposite direction to close out the contract. So the difference is the spread, the price at which you're buying or selling the asset. There are no other commissions, no underlying fees, and none of the above. Okay, but you have to be aware. So when it comes to Forex, futures, and CFDs, you will most certainly find that the major spot Forex pairs, and no matter what you're trading, are the cheapest to trade. The euro-US dollar, because it is so popular, so liquid, and because it is used as a pricing model, that it is going to have the tightest spread. When you trade exotics, they're going to have the biggest spread. When you're trying to trade the South Korean won or the South African rand, they're going to be more and more expensive because the volume isn't high and the cost of that asset's high. Okay. But then when you go to gold or oil, they're going to be relatively reasonable. Again, when you go to off-price things like platinum, palladium, the spreads are going to be higher, but the spread is always there. You know what it is before you make a trade because the buy and the sell costs are listed right on the screen. The CFDs will probably be more expensive than spot Forex, and in turn, ETFs will probably be more expensive than most CFDs. Unfortunately, the cost does not end there. Forex brokers also charge extra to hold most of their trades overnight, but very often do not advertise these charges explicitly on their website. Again, it's not because there's anything underhanded. It's because they are so competitive and they are so tiny that it doesn't make much of a difference to anybody. Okay, holding a Forex pair overnight and you've got $100,000 of it at 1% interest, if you do all the calculations, it's virtually nothing. But you should be aware, and because it is so minute and so competitive, the brokers don't announce it, but I've never seen a variance between brokers. Now, there's some underhanded brokers, but regulated providers, it's always virtually the same. But when you ask, they'll tell you where it is. It's on their website. It's published. It's available to you. You just have to kind of ask. Now, it's important that each trader evaluate the risk involved in each style of trading and understand the differences and the potential traps and errors. Do not trade what you do not understand. So if you don't understand the asset, the reason it's moving, or you don't even understand what CFDs are, please find out before you actually make a trade. Now, the difference between where a trade is entered and exited is a contract for difference, plain and simple. A CFD is a tradable instrument that mirrors the movement of the asset underlying it. It allows you for profits and losses to be realized when the underlying asset moves in relationship to the position taken. But the actual underlying asset is never owned. Essentially, it's a contract between, and this is one of the crucial points, essentially it is a contract between a client and a broker. Trading CFDs has major advantages, and these have increased in popularity of the instruments over the last several years. But remember, a CFD is between a client and a broker. It is not an exchange-traded item. Even though it is regulated and monitored, it does not go through an exchange. CFDs are undoubtedly one of the most widely traded financial instruments in the UK as well as the European markets, growing in popularity as traders around the globe become more familiar with what they are and how they can be utilized as part of a broader trading portfolio. They are traded predominantly off exchange. That means through a broker rather than a stock exchange. But this is a very important and crucial differential because it can be very beneficial to you and I. CFDs provide completely built-in leverage for traders looking to ramp up their earnings and utilize a considerable more flexible tool for investing on the power or weakness of long-term assets or index performance. Now, to give you an example why CFDs are more practical and beneficial to us, okay, is if you remember 2 years ago when the Swiss National Bank pulled the peg from the Euro's Swissy and the Swiss franc soared and the market crashed. You saw brokers all over the world, mostly in the UK, go broke overnight. They didn't go broke because they were trading in the wrong position. They went broke because they lost their capitalization, because so many traders' balances went in negatives, and the broker is the one financing your leverage. So when your account goes negative, there's no stock exchange out there. The broker's the one who loses that money, and when his capital dissipates, he loses his regulation because he must keep so much capital available to regulate. So like when you saw El Pari go, or you saw FXCM having to borrow $300 million in a matter of a couple hours, okay, this is what happens. But it hurts the traders because when this happened, all these traders that had stop losses or were calling their brokers, they closed my position. Okay, you can only close those positions, or they can only generate those stop losses when they can complete that trade through the exchanges or through the computers online, because there's no guarantee to a stop loss. There's no guarantee to a close because they must facilitate the transaction through the online network. Where when you're trading a CFD, since it's traded directly with the broker and it's a broker offer product, there is no wait for liquidity. It is closed at that point. So CFDs provide much higher leverage than traditional trading. Standard leverage in the CFD market begins as low as 2% requirement, depending on the underlying asset or shares. Margin requirements could ramp up as much as 20%. Now, I know a lot of us have seen all the news articles about all the regulators throughout Europe changing and cutting back leverage. They have been doing this, and we don't even know where. There's been no final rulings. Even in the UK, where they are cutting it back, it hasn't been enacted yet. The brokers have made the adjustments. So the CFDs have been adjusted to the leverage provided or allowed by the regulator. Now, we used to be able to go, or broker used to be able to go up to 400 to 1. Okay. The regulators have said no. They've cut it back to 50 to 1 for experienced traders, 25 to 1 to inexperienced traders. The brokers are fighting that and fighting with the regulators, but the regulators haven't come out with a final determination. No, because the regulator's job is to protect the investor's interest, okay, not to prohibit the investor. Okay. So most of the brokers feel that maybe leverage should be a 50 to 1 or 25 to 1, but if a particular trader wants to request because they're knowledgeable or they want to do something, should be entitled to get higher leverage as long as the broker's willing to offer it. So we're waiting for a final outcome or final rulings from the brokers, but right now, from the regulators, but right now, all the brokers, especially CMS, have made the adjustments to what the regulators have asked for until they've determined their final position. But 50 to 1 leverage is still pretty good. That means with a $1,000 in your account, you can control up to $50,000 of an asset. So the problem is, it's very, very scary because too many traders don't understand leverage or take advantage of leverage, and when leverage moves in their favor, they're very, very happy. But when the trade moves against them and they lose their whole account because they were trying to make more money than they should have, they want to blame it on the broker. So then what they do is they complain to the regulator. It's really who should discipline who. Do you put rules in to prohibit everybody because some people don't use it, or should you teach people, give people the knowledge and the ability to understand what they're doing? Now, while CFDs appear attractive, they also present some potential pitfalls. For one, having to pay the spread on entry and exits eliminates the potential to profit in small moves, which to some people, this sounds unattractive. To me, it sounds very attractive because you shouldn't be looking at a trade that's going to move 8 or 10 pips. because then you're kind of just guessing. You should be going in the market looking for something that's going to move 50, 60, 70 pips. So everything has a cost to it. Okay, in this case, what happens is if you're trading and your trade goes in your favor and only goes a few points in your favor, you may end up with virtually no profit. If it goes against you, you may have some loss plus the spread. But the fact is, when you're making money, you don't really care what your costs are. It's when you're losing money that you get upset. But the fact is, this is the cost. If we took the spread out and just charge you, $200 or $300 per trade, well, it's the same basic thing. This way, the difference is how much you're trading and how much you're making. The spread will also decrease winning trades by a small amount and will increase losses by a small amount. So while other types of trades expose traders to fees, mortgage regulation, commissions, and higher capital requirements, the CFD market has a way of trimming traders' profits by way of larger spreads. So no matter what you're going to trade and how you're going to trade, the broker has to make a living. The exchange has to make a living. There's fees for processing anything. Back in the old days, before we had online trading, you had only broker. You had a broker and an account person, and they charge you commission. Back in the days when I was a kid, a trade, just one trade well, you can only buy round lots of stock, but the minimum was $100 commission. Today you can buy them online for $9 a trade. But the fact is, everybody has to get paid for their work and their labor. So also note that the CFD industry is not highly regulated. The credibility of the broker is based on reputation, lifespan, and financial position. But the CFD industry is regulated. The difference is because it is a broker-initiated product and an off-exchange product, that the actual product isn't as regulated, but the trading is regulated. So there's nothing you really have to worry about. There are many fantastic CFD brokers, but it's important, as with any trading decision, to investigate whom to trade with and which broker best fulfills your trading needs. And this is one reason you should be using a well-known broker like CMS Trader, because you can base use their reputation and their lifespan to actually understand that the contracts they're offering you in CFDs are legitimately offered contracts and moving in direct connection to the underlying asset. Now, getting grips with the nuances and pros and cons of different trading instruments is essential to building a solid portfolio. And while futures and CFDs do bear a number of notable similarities, it's important to remember they are fundamentally different products with fundamentally different characteristics, which may lend themselves more closely to specific trading scenarios. So even though price of both a future and a CFD are moving with the underlying asset and moving basically in conjunction, remember with the futures, you can buy a May, a September, a December, you can buy a 2019 gold contract. Okay, and these prices do trade slightly differently, but when you're talking about current price, spot price, and the futures contract for the current month, you are talking about virtually the same thing. Now remember, with futures, you are dealing with a time deadline also, which makes it very different. So there is, if you want to trade with futures, there is less liquidity than broker CFDs. Because CFDs are largely traded directly with the broker, it's commonplace for a CFD broker to act as the market maker in situations where positions cannot be directly matched. This has the effect of making CFDs generally more liquid than futures, which in themselves are a reasonably liquid derivative. This means orders get filled per your request and when you request it, ensuring you preserve your profits and get your payout you anticipate when you executed your settling decision. Expiration date. The expiration date attached to futures serves to build in price decay, whereby the value of futures contracts is gradually eroded, all things being equal, and the closer we get towards the expiry date. But beyond that, the definite end date eliminates the flexibility of the CFD. one of the CFD's greatest strengths by stipulating and compelling the bearer of the futures contract to act on his order on that date, whereupon CFDs can be allowed to run indefinitely. Okay, futures have a set in stone date to expire. So in other words, if you were trading a future and you're heading towards the expiration date, you have to close. A CFD, as long as you've got the money to cover the stop loss and cover the flow of the market, you can keep that CFD going till the market moves in your favor. Now, also, we're talking about barriers of entry. Futures contracts are often prohibitively expensive for smaller traders to invest in because of the rigid size of the contracts involved. While one CFD is usually equal to one share, that definitely isn't the case with the futures. And traders will often be required to fund a hefty amount of capital upfront in order to acquire an interest in the markets, whereas CFDs are more flexible. And especially if you want to get involved in CFDs for indices, buying one share of the S&P 500 is prohibitively expensive, but you can get one share of the S&P or one unit of the S&P in a CFD contract for virtually nothing. So there are many things you need to consider. There are some other things when choosing CFDs or futures. They are both leverage. Your money, which in practice means that you are charged interest by your broker. However, while with CFDs, the interest is charged on a daily basis. With futures, the charge is priced into the asset. As stated, the competition for your business should ensure that the rate charged is reasonable, but this is something you need to check. As CFDs are typically a trading vehicle and you don't buy them to hold for a long time, the interest is usually not high enough to be a problem or even noticeable. But they do give you a choice to hold onto them longer if you need the price to swing your way. And when you trade futures, you may not have the luxury of enough time for this to happen. Now, leverage offered by brokers allows you to open positions larger than your actual capital. At CMF Trader, we offer up to 200 to 1 leverage on various CFD instruments. Again, as I stipulated before, CMS is a regulated provider. There are different regulators and different requirements per country. So it really depends on where, and I have a huge audience out here from all over the world. So the CFD offer, but automatically it will be correct on your platform in your country. But for instance, CMS Trader, when we were offering 201 leverage on various CFD instruments, which means you would only need 0.5% of your position size in order to open a trade. For instance, if you wish to trade crude oil, buying 20 barrels at the price of $44. Now in the futures market, you couldn't buy that because it's 1,000 barrels per contract, or 42,000 gallons of crude oil. But if you wanted to buy just 20 barrels on a CFD, you could buy just 20 barrels at $44, say, the price of a barrel. Then your position size would only be $880 US. However, due to the 100 to 1 leverage offered by CMS on crude oil, you would only need 1% for your position size, or only $8.80 to trade that position. So if you had a small account and you only wanted to risk or wanted to trade $100, for $88, you could tie up, what, 20 barrels times 10 higher, or 200 barrels for $88. Okay. That means if crude oil moved $1 or $2, which it tends to do in a trading session, you could make a lot of money. Leverage trading can magnify traders' profits. However, at the same time, once you take into account that losses can be magnified as well. So I'm going to keep on renewing this. CFDs are a leverage product. This means you gain a much larger market exposure for a relatively small initial deposit, meaning your return on your investment is significantly larger than in other forms of trading. In conventional dealing, you would have to pay your broker a total value of the asset you wish to purchase, But with CFDs, you're only required to provide a fraction for the same trade so that you can make your investment amount go a lot farther. So let's give you a very specific example. Let's say you wanted to buy 10,000 shares of Barclays, and Barclays was trading at 280 pence, which means that your total investment would be £28,000 if you were actually buying the shares, okay? Not including the commission or other broker fees that would be charged you for the transaction. With the CFD trader, however, you only need a small fraction of that value of that position to maintain the level of exposure. Now, if you bought those 28,000 shares and laid out that £28,000, okay, you could sit on those shares for the next 100 years. You could sell them when the market was up, and you don't have to worry about stop losses or take profit points. You don't actually have to even worry about losses. If those shares go down in value, until you go to sell them, it doesn't really matter. So it's like your house. You know, your house one day is worth, you know, £500,000. The next year it drops and it's worth £400,000. You're a little disappointed, but 3 years later it's worth £600,000. So you sell it when it's worth $6. But the difference is you had to have the £28,000 in cash. Now, at CMS we give 10-to-1 leverage or 10% leverage on shares. So on the Barclays shares, you would only need a deposit of £2,800 to trade that same amount. Now, if Barclays shares rose 10% to 308 pence, the value of your position would then be £30,800. So, with the initial deposit of £2,800, the CFD trade would have made a profit of £2,800, which is a 100% return on your investment, compared to just 10% return if the shares were actually bought physically. Because if you only had those £2,800, you can only buy, what? A few shares. The important thing to remember about leverage, however, it is that while it can magnify your profits, your losses can also be magnified in the same way. And I know I keep saying this over and over again, but because we're a regulated provider, we are required to constantly remind you about risk. And we will always remind you because we want everything to remain up above board and want you to be aware that this doesn't mean that the only thing you can lose is your £2,800. That's only a deposit. Okay. So if price moves against you, your losses could exceed your initial deposit. So it's important to understand how to manage your risk. And one of the safest ways to last in the markets and trade to be a successful trader is forget about your profits and always manage your risk. If you always manage your risk, you'll find that you'll stay in the market long enough that you will eventually be very profitable. Now, CMS Trader offers attractive trading fees, charging only the spread of the open position. Spread is the difference between the sell and the buy price of a certain instrument. When calculating a cost of position, you need to multiply the spread by the size of the position. This is the spread charge for a position. For example, if the spread for crude oil is 0.04 cents, the cost of opening a 10-barrel position is 0.04 times 10 barrels, or 40 cents US dollar. Most of the CFD instruments that are traded on floating spreads, which means that the spreads are affected by the liquidity in the market. Now, all of us should know this. The spreads don't change instantaneously. They don't get recap. Spreads are basically standardized, and you can look up on us, on the broker site what the spreads are. But spreads can be changed by the broker or the regulator. So, for instance, as we go into the French elections, brokers are tightening the spread available to you on the euro because the euro might have huge amounts of volatility. It is only there to protect you from losing more than you can afford to lose. The more liquidity, the narrower the spread will get. Only 3 instruments have fixed spreads over time: gold, silver, and crude oil. You can review the offered leverage and spreads of all CFD instruments in the trading terms and conditions and charge pages on the CMS Trader's website. All of this stuff is disclosed. There's nothing irregular, underhanded, or deceptive about it. Now, CFDs are available in a huge range of different assets, including global indices, stocks, sectors, currencies, and commodities. Unlike futures contracts, CFDs have no fixed expiry date or contract size. Trades are conducted on a leverage basis, and while a trade remains open, your CFD account will be debited and credited to reflect any daily financing costs and dividend adjustments. So if, while you're holding a CFD, a company, if you're trading in shares, offers a dividend, you collect on that dividend. If you're trading on treasuries, you also get any shift in the financing costs. You can go long or short, and a CFD reflects the price movements and pricing of the underlying asset in which they are based on. You usually deal at the cash market price. CFDs provide access to movement in the asset price by putting down a small amount of the total market. There is no restriction on entry and exit prices of a contract for difference. Positions will be closed at any time during normal market hours. A CFD can only be closed by making a second reverse trade of your original long or short position. Commission or spread is paid on each side of a CFD. Now, again, we'll give you another example. Okay. Peter has been trading shares and derivative investments such as options for 10 years and has recently started to trade in CFDs. Peter's a hypothetical friend out there. He shopped around and looked at many CFD providers before opening an account. Eventually landed here at CMS Trader. Now, Peter's been doing some research on Beta, a company called Beta, and he thinks that his share price is well undervalued. He decides to take a long position or to buy it to go up on a CFD over Beta shares. The current price of the CFD over Beta shares offered by the CFD provider is $5. Peter logs into his CFD trading account and places an order for 4,000 Beta CFDs, or 4,000 shares. His offer is accepted by the CFD provider at $5 per CFD. Okay. This is what they were trading at. The total contract value is $5 per unit or per share times the 4,000 shares that he bought, or equal to $20,000. Straight, easy calculation. The CFD provider requires a 5% margin to open the trade, which is deducted from Peter's CFD account. The margin is equal to $20,000, which was his 4,000 units or shares, times the $5 per share, and he's required 5% of that in stock trades, which is equal to $1,000. The provider also charged Peter a commission of 0.15 on the contract value, which is $30 on his trade, because shares are traded at the share value price. What happens next depends on what happens to the price of Beta. Now, Peter's tied up his 4,000 shares at $5 a share. It's cost him $30 for his trade. The $1,000 margin is not a cost. It's just a deposit. That's it. I mean, it gets credited back to your account. Now, if Beta shares goes up to $6, Peter sells his position. He closes out. He made $1 per share times 4,000 shares, or he made $4,000 less his $30 cost. If Beta shares went down $1, he would have lost the same $4,000 plus the $30 cost. The success of CFD trading doesn't just depend on picking the right CFDs to trade. When you trade CFDs, you're relying on the CFD provider to accept and process your trade, make payments owed to you while your trades are open, credit any proceeds of profitable trades you, and pay you money out of the CFD trading account when you ask for it. If the CFD provider gets into financial difficulty, they may fail to meet some or all of these obligations to you. This is one of the reasons you need to trade with a regulated provider, because that regulation makes sure that your money and your capital is separated at all times and that you're always paid on your account values. Otherwise, you're covered by the insurance from the trader, from the regulation agency. But most regulated brokers don't go belly up on you. This means that even if you've been trading profitably, you may never receive profits, especially when you're trading from unregulated brokers, because they don't have any capital requirements and nobody's monitoring where their cash is going. These are reasonable for you. These are reasons that you should trade with a well-known respected provider such as CMS Traders. So just go to www.cmstrader and click on the buy or the sell button right on their home screen, and it just asks you 3 questions, most is an email address and your name, and they'll open a demo account for you, and then you can start practicing on their platform. See what the CFDs are like. Trade a couple CFDs. See what understand what we talked about tonight, and then maybe you want to open up a real trading account with CMS, and they'll make it easy for you, and they'll help you with education. They'll help you with one-on-one training. They'll do whatever you need to help you along the way. So thank you very much for joining us tonight, and have a great trading week, and we'll talk to you again real soon. Good night now.